Thank you for joining us for Part 1 of the Financial Literacy Workshop Series, Keeping Red Foxes in the Black. My name is Bobby Sue Teletasi, and I work in the Advancement Office at Marist College. This session will cover financial goal setting, budgeting, managing credit card and student loan debt, and managing taxes. Before we begin, I would like to briefly introduce our speakers. Brian Hawhey is an assistant professor of finance here at Marist and also runs the new Student Investment Center. He is a chartered financial analyst and financial risk manager. Brian has worked in the securities industry for over 20 years, most recently as a consultant to investment management firms. Phil LaRocco is a professional lecturer of accounting at Marist. He is a certified public accountant and financial planner. Phil's prior work experience varies from a small accounting firm in New York City to a Fortune 500 company. Phil has owned and operated a small accounting practice in Wallkill, New York since 1985. The Advancement Office would like to thank both Brian and Phil for sharing their time and expertise with Marist alumni. We'd also like to extend a special thank you to Rob Egan from Academic Technology for making this webinar possible. A brief disclaimer before we begin tonight's workshop. This presentation was prepared for educational purposes only. It is not a recommendation of any particular security, strategy, or investment product, and should not be used solely to make financial decisions or investments. You should consult your financial and tax advisor before engaging in any transactions. At this point, I'll turn it over to Brian and Phil for our financial literacy workshop, Keeping Red Foxes in the Black, Part 1.
Thank you, Bobby Sue. This is Phil LaRocco, and I'd like to spend a few minutes to review the topics Brian and I will be discussing tonight and during our next webinar. Tonight I will be speaking on the importance of making a financial plan. While this webinar is for Marist young alumni, it is never too early or too late to plan. As part of making a financial plan, which will change over time, we have to know how we are spending our money. I will briefly discuss the difference between a budget and a spending plan, how one is created, and why budgeting is for life. Brian will then talk about debt, good debt versus bad debt, credit cards, your credit score, buying a house, and different types of mortgages. I will conclude with a talk about completing Form W-4 Employee Withholding Allowance Certificate and why some of you may be making interest-free loans to the government. I will also show you an online IRS website that will calculate your withholding allowances. In our next webinar, we will be discussing investing, retirement planning, insurance, and some tax items. Our goal in both webinars is to do an overview of important financial topics, and hopefully this will be helpful in developing your financial plan. Remember, before you make any financial decisions, you should speak to a professional. Those who practice financial planning will tell you that financial planning involves a team approach: accountant, lawyer, investment advisor, insurance broker, and no one person should be relied upon to render all financial planning services. Question: what is a financial plan? Well, it's a roadmap to achieve your lifetime goals. Goals can be short or long-term. Goals will change over time. If you attend both webinars, there are issues that you will discover belong on your financial plan which you may have never considered. I will touch on a few of those items. Some short-term goals may be to pay off your student loans, credit cards, or buy a car. Once married with a family, with or without a house, raises some goals or issues you might want to address. Assuming you are the main source of income to your family, what happens if you are disabled or die? Who is going to pay for the needs of your family? The house, education, retirement. Where is this money going to come from? There is a way to plan for life's unexpected turns. My point is that we all have goals, and one of them should be for the financial interests of our families at different stages. Insurance planning will be addressed in the second webinar. Question: why should you have a budget? Well, you really should have a budget to match your receipts with expenditures and to plan for those fixed and variable expenditures, which I'll define later. We want to be able to create an emergency fund, which again I will talk about shortly, based on your fixed expenditures. You also want to know where your money is going and to enable you to make choices to modify your spending. Now what usually happens with a budget is that the budget becomes like one of those New Year's resolutions to lose weight, and usually is abandoned shortly after it begins. For those of you who have never prepared a budget or have attempted and abandoned, there is a better way. Instead of using the term budget, let's use the term spending plan. A spending plan sounds like fun. A budget and a spending plan are similar but not the same. While a budget can be constricting, a spending plan can be liberating. Okay, so what's the difference? What's the difference between this budget and spending plan? Well, both a budget and a spending plan break down monthly expenditures into two main categories, fixed and variable expenditures. Now here's my definition of a fixed expenditure. It is something I have to pay regardless if I have a job or not. Fixed items would include a mortgage or rent payments, loans, food, utilities, etc. Variable expenses would be those items that we have the option to acquire, but there is no requirement to expend funds, entertainment, vacation, sporting events. In essence, fixed expenditures are our needs, and variable expenditures are our wants. Someone's needs may be another's wants, so you have to decide. We have a battle between needs and wants every day of our life. Now at this point, let me state the following. The first thing to remember in preparing a spending plan is to pay yourself first. Let me repeat that. Pay yourself first. Sometimes when individuals prepare a spending plan, if there are excess funds at the end of the month, that becomes their savings. This is the wrong approach. Money must be set aside first for you to accomplish your goals. It does not matter how much. Just get into the habit of paying yourself first. This can be done by a direct deposit into a savings account, brokerage account, or retirement account. As your income increases, this amount will increase. The recommended amount of savings is 10% of gross income. Start at 3%. And if your employer matches your contributions into a retirement plan, which we will discuss in webinar 2, your 3% is now 6%. While 10% may not be practical today, it is a goal to achieve in the future. So again, let me repeat the question. What is the difference between a budget and a spending plan? Well, while both a budget and a spending plan require a segregation of fixed and variable expenditures, a budget generally has already allocated the amounts to those variable expenditures based on the previous year. The assumption is that you will continue to spend as in the past. Sometimes, as you prepare a budget, you feel that you no longer have any control. It's very constricting because all the fixed and variable expenditures have usually been accounted for, leaving you with not much free cash at the end of each month. Well, here's how a spending plan differs. While a spending plan does allocate those fixed expenditures by month, it does not allocate any predetermined prior year variable expenditures. Let me repeat that. A spending plan does allocate those fixed expenditures by month, but it does not allocate any predetermined prior year variable expenditures. Each month, you have the option to decide what you want to spend your variable excess funds on. You have the freedom each month to decide. You are in control, and the likelihood of the spending plan to succeed is far greater than a budget. For example, this is October, so you may decide to put a deposit on a January vacation next month. Maybe next month Christmas gifts. So with a spending plan, you have the flexibility to decide. And remember, the key to achieve your financial goals is to pay yourself first. Question, this spending plan might work, so how do I create a spending plan? Well, assuming you know your fixed expenditures each month, we just need to determine your monthly variable expenditures to see how we are currently spending our money. There are two reasons to know what we are spending our money on. Number one, if we know what we are currently spending our money on, we may be able to modify our spending habits, and two, enable us to make choices by categorizing spending by order of importance. If you use a debit or a credit card to pay for everything, there is a good chance you are probably spending more than you should. It becomes a reflex action to swipe the card. You use the card and pay no attention to the cost. The good thing is that you can find out where your money is going by reviewing your statements. So if you use a debit/credit card to pay for everything, go back 2 months and review what you are spending your money on. Use whatever categories you want. At this point, some of you will be shocked to see how much is spent on certain categories. This is the beginning of taking control of your spending. Now you can decide what you want to spend your money on each month and be more aware of the categories of expenditures you will have to watch or eliminate. For those of you that pay cash for everything, you may have to monitor your expenditures for 2 months before coming up with your categories. Once you know what you are spending your money on each month, the variable expenditures, this will force you to make choices and to get on with your financial plan. And remember, pay yourself first, and you want to keep the spending plan simple. Now, in conclusion, and again, we're only doing an overview of budgeting and the topics tonight, but in conclusion on budgeting, you can download Excel templates to assist you in developing a spending plan. You can also purchase software such as Quicken, which will monitor your actual expenditures to any budgeted amount. Some banks enable you to download monthly disbursements directly to budgeting software. The best way, in my opinion, is to buy a financial planning book and to read it. Budgeting for life. Now, you might think that budgeting is just a temporary thing, that you do it and that's the end of it. But I mentioned budgeting for life earlier. I know this is a young alumni webinar, but I want to make a point about budgeting for life. The question I am frequently asked by some of my clients is, can I retire? My response is, what is your retirement budget? Depending on what someone plans to do in retirement will help me to advise them. Some people will spend more money annually in retirement because of travel plans, medical issues, vacation homes, etc. So remember, budgeting is a lifetime activity. Now, a couple of questions people ask me sometimes, and here's one of them. How can I reduce my spending? Well, after reviewing where you currently are spending your money by establishing categories, it is time to see if your spending can be reduced. Possibly doing a loan consolidation can take a few monthly payments and reduce them into one. The interest rate on a personal loan would be significantly less than the interest rate on a credit card debt. Maintaining your car can improve gas mileages. Using certain light bulbs reduces electricity. Taking a defensive driver's course could reduce your auto insurance, and so on. Once we know what we are currently spending can trigger savings. Now, I mentioned earlier something called an emergency fund. And what is this emergency fund? Well, the rule of thumb is to maintain 3 to 6 months of those fixed expenditures, those things that you have to pay, regardless if you have a job or not, in an emergency fund. If you lose your job or become disabled, you will need money to pay for those fixed expenditures. And again, the rule of thumb, the 3 to 6 months, is just that, a rule of thumb. Each situation is different. A married couple with both spouses fully employed probably needs 3 months, while a single individual, a couple with one spouse employed, would be closer to 6. The money should be liquid and not in a retirement account. Taking money from a pre-tax retirement account will cost the average taxpayer anywhere from 30 to 45% in penalty and federal and state taxes, depending on their bracket. Start small with the emergency fund and build it up over a few years. Another question, what is my net worth and why is it important? Your net worth is everything you own less everything you owe. It's your assets minus your liabilities. One of the first steps in the financial planning process should be to calculate your net worth. This will enable you to know exactly what you have and what you owe, allowing you to begin the process of figuring out your financial future. Your net worth will change over time, hopefully going up, and should be recalculated annually. Do you know what your net worth is? You might be surprised. When do I need financial advice? Well, starting a career is the perfect time to establish good financial habits and developing a relationship with a financial advisor. If your employer offers a retirement plan, did you select the correct type of investments? Brian will be speaking about that in webinar number 2. Do you know the stock market has increased 20% this year and a savings account less than 1%? Another time you might need financial advice is getting married. A financial planner can help you define your goals as a couple and make sure you are utilizing your employer benefits to the fullest. Do you have adequate life insurance? Again, another topic to be discussed in webinar 2. and that the investments you chose are the appropriate types for your goals and risk tolerance. Another time you may need some financial planning advice when you begin a family. Is it time to start thinking about college savings? Do I need to update my will? Do I have adequate insurance? And obviously, when it involves retirement planning, will I have enough to retire? Will I run out of money in retirement? So in conclusion, on this area of budgeting, you have to do your homework and read financial publications. I personally subscribe to Kiplinger's Personal Finance. Let me repeat that. Kiplinger's Personal Finance, and I'll ask Bobby Sue if she could post that. An excellent site is the American Institute of CPA's 360 Degrees of Financial Literacy. Just Google 360 Degrees of Financial Literacy. It has many charts, tables, and a lot of useful information. The book we are currently using at Marist for the One Credit Financial Literacy course is titled The Everything Personal Finance in Your 20s and 30s book, 3rd edition by Howard Davidoff. You can buy the hard copy or ebook for less than $15. Also, I will ask Bobby Sue to post this information. I'd like to thank you, and I want to turn it over to Brian.
Okay, thanks, Phil. So I'm going to continue on focusing on debt. So when we talk about debt, we're talking about any borrowing that we do. And this isn't just restricted to traditional bank loans. It also includes advances on credit cards, student loans, car loans, and leases, etc. And incidentally, while they're not debt per se, we can also think about future obligations here, such as property taxes, for example, that we know we're going to have to pay in the future. So when we talk about debt, we're talking about borrowing money to purchase something today that we don't have the money for readily available. We probably expect to earn that money sometime in the future, but we want to be able to spend it today. And economists refer to this as accelerating consumption, while lending or investing they refer to as deferring consumption. We have to pay for the privilege of borrowing from someone else in order to buy something today, and so that has the effect of increasing the cost of whatever we finance or borrow for. Since this borrowing increases our costs, we ought to be really careful to make sure that what we are buying is worth this real price, that is, the price including the cost of borrowing. In this vein, finance and accounting folks like to think in terms of good debt and bad debt. Good debt is when we're borrowing to purchase something that will increase our net worth, which Phil spoke about. What we mean by this is, can we reasonably expect that our total assets and savings will be increased by entering into this transaction? For example, if we decide to borrow money so that we can go to college, that's probably a good idea. If we gain more education, perhaps a graduate degree, this should increase our appeal to prospective employers. They should be willing to pay more to hire us so that our future earnings will increase. If this is more than the net cost of borrowing, then this is good debt. A loan to buy a house can be a good idea too, although not always. There's some things we have to consider. The cost of the loan. Are there any alternative solutions, such as the cost of renting a house? If you're thinking about buying a car, you're also going to have other costs that you need to take into account. You're going to have to pay for insurance, for parking, for repairs, and for gas, etc. Like in New York City, for example, parking can be $400 a month or more. That's $5,000 a year. Okay, so credit cards. Credit cards are like chainsaws. They can be very useful for us, but they can also cause a lot of damage and inflict a lot of financial pain. We should be careful of them for two reasons. First, they encourage us to buy things on impulse, just like Amazon's one-click purchase does. Things that we may not really need. It's much less painful in the short term to hand over a credit card instead of real cash. Of course, the financial day of reckoning always comes, and that's when we get our credit card statement. And that leads to the second reason they can lead us to hurt ourselves. We may start to run up debt by not paying the balance on our credit card off promptly. This is a bad idea, because when we don't pay off our entire balance, we're borrowing from the credit card company, and doing so at a high rate of interest. Here's some background information. According to the Federal Reserve Bank of New York, U.S. households owed $8.38 trillion on mortgages in the second quarter. They owed another $2.85 trillion in consumer debt and another $1 trillion in student loans. And total U.S. consumer revolving debt in July of 2013 was $850 billion. 98% of that was made up of consumer credit card debt. Now, billions and trillions are hard to understand, so to put it in context, the average credit card debt per household is $7,000. However, since not every household actually has loans, the average credit card debt for those who do is $15,000. The average mortgage debt is $147,000, and the average student loan debt is $31,000. And the average consumer has an average number of 3.5 credit cards. These numbers are down significantly during the economic downturn. Prior to 2008, Americans averaged 5.5 credit cards. There's almost 180 million credit cards holders in the U.S., and the average age to first get a credit card is 20.8 years. And the average interest rate that people pay on their credit cards, the average APR is 15%. Your credit score is based on credit information that's collected by credit bureaus, and three examples of those are Experian, TransUnion, and Equifax. And these organizations keep track every year of the bills that you have, the payments that you've made, and whether or not you've been late in making those payments. And related to that is something that's referred to as your Fico score. This comes from an organization called Fair Isaacs Corporation, and hence Fico. And this score is based upon your credit report. It ranges from about 300 to 850, and the median is about 720. So that means that about half the people have a score higher than 720 and half have a score lower than 720. Well, you want to be in the half that's higher than 720, because the higher is the better. It'll cost you less to borrow money. So how do you improve your credit score? Well, the most important thing to remember is to always pay your bills on time. Don't carry a balance on your credit card, but instead pay off your credit card bill every time you get it. If you haven't yet taken out a loan, take out a modest loan and repay it over time. Don't have too many credit cards, although you do want to make sure that you have at least one, and have it for as many years as you can. So if you have an old card, keep it, because the length of time for which you have a card improves your credit score. And remember that your credit score isn't always accurate, so check it annually. You're entitled to check it once per year for free, and you want to make sure that it's accurate for two reasons. One, so that your credit the credit that you're going to be charged in future is fair and reasonable, but more importantly, you want to make sure that you're not a victim of identity theft. This would be where somebody comes and impersonates you. They use your social security number or your name and address to take out credit in your name, maybe to fake a credit card. So this is a very, very prevalent problem in the U.S., and it's one that you need to be aware of. So always check your credit score at least once a year, and we'll ask Bobby Sue to put details up on the website for how to do that. So now let's talk a little bit about buying a house. I mentioned that buying a house can be a good thing, although not always. So why can it be a good thing? Well, first of all, it provides somewhere for you to live. Secondly, it helps you build equity because it forces you to save as you pay your mortgage every month. And thirdly, there can be tax benefits if you have a mortgage. On the other hand, there are some disadvantages. First of all, you're going to need to come up with a down payment, usually about 20%, although on occasion it can be less than that. Also, when you do take out a mortgage, the interest on that mortgage is going to be front-loaded. And what I mean by that is that for the first few years of your mortgage, the bulk of your payments are going to be interest only, so you won't actually see the balance declining very much on the loan amount. There's also what we call an opportunity cost, and that's relates to the fact that the money you're using for the down payment, you could have invested in some alternative instrument, like in the stock market, for example, or investing in somebody's business. The other thing to remember, as we saw in 2007, is that house prices don't always go up. Sometimes they decline, and sometimes they decline precipitously. Another thing to remember too is that you have to pay a commission when you purchase a house, and usually that commission is 6%, and that adds up pretty quickly. On a $300,000 house, that'll be close to $20,000 just in commissions. And speaking of costs, don't forget that you need to pay lawyers, and you also need to pay you may need to pay mortgage points, and we'll talk in a moment about what mortgage points are. But if there's one rule of thumb, it's generally this: don't buy a house if you plan to move within the next year or two, because the costs will be overly onerous. So mortgages. When you're taking out a mortgage, or when you're applying for a mortgage, there'll be a couple of pieces of information that you'll need to provide to your mortgage broker or the mortgage banker from whom you'll be looking for to take out a loan. And one of the things that they will do is calculate some ratios, the front end ratio and the back end ratio. And these two ratios really are a measure of how much of a mortgage can you afford to carry. So the front end ratio, there's usually a maximum of about 29 or 30% on this. And this is what's the proportion of your monthly payment of principal interest plus the tax and the insurance expressed as a percentage of your monthly income. And similarly, the back end ratio, which usually maxes out about 40%, that's the total amount of debt that you have to the total amount of gross income that you have on a monthly basis. Remember that when you're taking out a mortgage, you'll probably have to pay what we call PMI, or private mortgage insurance, and this is insurance to protect the bank in the event that you die or you lose your job or you're disabled, so that there'll be an insurance policy in place to pay off your mortgage. If you're looking for the best rate on your mortgage, you have a choice of applying to multiple banks, or you may choose to use a single mortgage broker. And the job of the mortgage broker is to collect the information from you and then basically shop around various banks to get the best rate for you. But remember, nobody does anything for free, and mortgage brokers will charge you a fee. And this could be 1 or 2 points of your mortgage. And when we talk about a point is 1% of the mortgage loan size. So if it's a $300,000 loan, for example, 1 point would be $3,000. When you're applying for a mortgage too, you need to decide, do you want a fixed rate mortgage or a variable rate mortgage? A fixed rate mortgage means that the interest rate is locked in today and stays fixed for the life of the mortgage. A variable rate mortgage is one where the interest rate usually is low at the beginning, but then will fluctuate over time if interest rates go up. And given where we are right now, most people would probably tend to opt for a fixed rate mortgage, because mortgage rates are at historical lows and are only likely to increase over time. And don't make the mistake of opting for what's called an option ARM, or an option adjustable rate mortgage. These are mortgages where you're basically encouraged to take out a mortgage for a loan amount that's more than you can afford. And the way that they do this is by the banks, they reduce the monthly payment that you have to make for the first couple of years. You pay less than the interest that accrues, but then that interest gets added to your loan balance. So your loan balance actually increases in size over the years, over the first 5 years, for example. And then, so after 5 years, the loan amount will have increased, plus your monthly payment will increase up to be the actual real amount. So that can be a big shock. So stay away if you can from option ARMs. But the other thing that can be to your advantage when you're looking for a house and you're worried about interest rates going up is to pay 1 or 2 points to lock in the interest rate. What I mean by that is that generally it's a good idea to approach the bank and apply for a mortgage before you find the house, because the bank will tell you how big a mortgage they're prepared to give you. And let's say it's $300,000. At that point, you can go out and look for houses in your price range. Now, that may take you 1 or 2 or 3 months to find a house that suits you, but you may be worried that over that 2 or 3 month period, interest rates will rise. So the banks give you the option of locking in the interest rate when they give you the mortgage commitment. But of course, they're going to charge you for that privilege. And again, that'll maybe be 1 point. And when you're figuring out how much of a house you can afford based on how much of a mortgage you can make, a monthly mortgage payment you can make every month, remember that there are additional costs that you're going to have to pay. You're going to have to pay taxes on this house. And depending on where you live, if you live in Westchester County, for example, in New York, a modest house could have a yearly tax bill of $30,000 or $40,000. If you live in Dutchess County, maybe your annual amount that you have to pay could be $10,000 or $15,000. So don't forget to take that into account when you're calculating whether or not you can afford a mortgage. Also remember that you need to insure your house. That'll be one of the requirements typically for a mortgage. And remember too that you'll have to pay water bills, and you have to pay heating and cooling bills too in the winter and summers respectively. And these utility bills, you know, you could easily pay $300-400 a month in the winter time to heat your house, and during the summer you could pay $600-800 a month on electricity to cool your house. So these costs add up quite substantially. So with that, I'd like to turn it back to Phil, who will continue talking about taxes.
So I'm going to talk about the W-4 Employees Withholding Allowance Certificate. Now, that W-4 form is the form you fill out when you get a new job. When you go to Human Resources, and they say, well, can you complete this form? Well, what's the point of that form? Well, the form determines how much your employer will withhold from you for federal and state taxes. And depending on what you put on that form will determine what your take-home pay will be. So as a rule of thumb, whenever you get a new job, with a new job, obviously, you have no choice. You have to complete it. Or a second job. Now, why do I say a second job? A lot of times people get a second job, and it's a part-time job. And because it's a part-time job, the withholdings on that amount are very, very low. So what will happen is the combination of the current job, full-time job, and that second job may put you into a different tax bracket, and you may owe money at the end of the year. Another one is, to fill out another W-4, is when you get married or divorced. Now, for tax purposes, your filing status is determined on December 31st. Well, what do I mean it's determined on December 31st? Well, if I'm single for the full year, and on December 31st I decide to get married, the government considers me married for the entire year. Now, that could be a problem. It could be a problem because now if I'm married, I have to combine the income of both husband and wife on the tax return. I could be married for the full year and get divorced on December 31st. Well, what does that mean? I'm single for the whole year. Another time that you may have to change your W-4 is when you have children. You have more dependents. More dependents generally means that you will pay less income taxes. Another situation is if you receive a large tax refund. And I mentioned this earlier. If you're receiving a large tax refund, you have now made an interest-free loan to the federal government. Think about it. In 2013, the federal government is withholding all this money from you. They're not paying you interest on it. You're not going to get that money back until sometime in 2014. So remember that getting a large refund is not necessarily a good thing. What about when you do your taxes, you owe a large balance? Well, if you owe a large balance, you're probably going to have to pay a penalty. Again, if you owe a large balance, it's a time to change your W-4. Buy a home. Brian just talked about it. All of those items that you're able to deduct for a home. Property taxes, mortgage interest, etc. So buying a home does give you some tax benefits which could reduce your taxes and probably will. What about anticipate other non-wage income, etc.? Maybe you have some investments, etc., that you're going to sell. You have to consider all of these when you complete a W-4. Now, I know when I first received a W-4 form, it was kind of complex. There were 2 parts to it, and most people just fill out the first part. But the IRS has made it a little bit easier for you to complete the W-4 form. They have a website. If you go to www.irs.gov, and I'll ask Bobby Sue to post this, you click on Tools, and there's a section there called Irs Withholding Calculator. Now, what will this do? This will enable you to put in certain data, and you will need it. To complete it, you'll need your last pay stub. If you itemize your deductions, which usually means that you own a home, you'll need that information on your taxes and mortgage interest, donations, etc. And you put this information into the online computer program for the IRS, and they will determine, or it will determine, what your withholding should be for the upcoming year. Now remember, I want to repeat, if you have received a large tax refund each year, you have made an interest-free loan to the government.
Okay, so we just got a question. Should I be saving for retirement or for my child's college fund? Well, really it depends. Any form of saving is good. Yeah, I need to think about this for a minute.
Okay, this is Phil, but I would like to say that the difference between saving for college and retirement is this. I can fund college. I can't fund retirement. So in my opinion, I would think that it would probably makes more sense to put money away for retirement. You could always borrow for college, but for retirement, you cannot retire and fund that. There's no way that you can do it.
So our next question is, with large debt, is it better to make 2 payments a month or 1 large payment a month? Well, that's actually a great question, and is one of the things I should have mentioned when I was talking about mortgages. It's always a good idea to pay as quickly as you can. So if you think about it, if you just have a 1-month loan, for example, and you wait till the end of the month, you're going to be charged interest on the entire loan for the entire month. On the other hand, if you make 2 payments on that loan and you pay 1 payment halfway through the month and then the second payment at the end of the month, you will only be charged interest on the entire amount for 2 weeks. And then for the second 2 weeks, you'll only be charged interest on half the loan amount. So because of that logic, any time that you've got large loans, it's always a good idea to try and pay as frequently as you can, usually twice a month. The next question that we've received is it ever a good idea to take advantage of low cost balance transfers, low interest rate transfers? Well, generally, yes. It's always a good idea to try and keep your interest rates as low as you can. However, there are a couple of caveats. One point that I made when I talked about credit cards is you don't want to have too many credit cards, because that will affect your credit score. Now, what you could do is you could cancel the old card, but if it's one that you've had for many years, then you're also going against the advice that we gave you, which was to try and maintain at least one of your cards for many, many years. The other thing that you need to remember too is that when you transfer money to a new account and you're offered these teaser rates, sometimes you can, because your monthly payment is low for a while, you may be encouraged to spend more on your credit card than you normally would. So bear that in mind. And of course, you need to look at the small print. You're getting a low rate for some period of time, but you want to be sure exactly what rate will the card be jumping up to once the teaser period is finished. It may actually be higher than the card you're moving from. So the next question that we have is, when is refinancing a good idea? And for those that aren't aware, refinancing is basically where you take out a new mortgage, taking advantage of interest rates that have dropped. So your new mortgage is at a lower rate of interest, and you use the proceeds of that mortgage to pay off the old mortgage. Well, remember that I said when you're taking out a mortgage, there are a variety of costs. You won't have to pay a mortgage broker typically, because you'll be dealing directly with the bank, and you certainly won't have to pay commission costs because you're not purchasing the house, you're merely refinancing it. but you still will have legal fees and you'll still have bank fees to take into account. So the general rule of thumb is that if you anticipate that you're going to be moving house within the next 2, 3, 4 years, it's not a good idea to refinance. On the other hand, if you anticipate that you'll be staying in the house for many, many years, then it makes very, very good sense to refinance and take advantage of the low rates. While you're doing it, one thing you could consider is changing from a 30-year mortgage to a 15-year mortgage. And there's several advantages to that. You end up paying less interest, and it'll force you to pay down the house earlier. Or what you can choose to do, and this is advice that Phil normally gives, is to make your new mortgage a 30-year mortgage, but pay it down as if it were a 15-year mortgage, so that in the event that you run into trouble down the road, you've paid off a significant amount of the mortgage and you've got more financial flexibility. So our next question is, if you have both credit card debt and student loan debt, which is the best one to pay off? Well, again, it depends. But normally your credit card debt is going to be at a much higher rate of interest than your student loan. And so I would normally recommend that you pay off your credit card debt first. And then just so long as you keep servicing your student loan debt, and then you pay that off later on.
If you have any additional questions after listening to this webinar, or ideas for future webinar topics, please email them to the Marist Alumni Office at maristalumni@marist.edu. That's maristalumni@marist.edu. We hope you found Part 1 of this financial literacy webinar workshop helpful. If so, be sure to check out Part 2 of Keeping Red Foxes in the Black, which examines retirement, investment, and insurance planning. Again, we'd like to thank our speakers, Phil LaRocco and Brian Hawhey, for sharing their knowledge. We'd also like to thank Rob Egan from Academic Technology for making this webinar possible. And we'd like to thank all of you for joining us. We hope you'll join us for future webinars provided by the Office of Alumni Relations at Marist. Thank you.